Welcome, guys, to Capital Conversations, Episode 5, How to Finance Your Real Estate Investment. We want to help you understand various financing options so that you can choose the best fit either for your first property or probably for most of you for additional properties. You can go back to the next slide, Cindy. So we're gonna discuss how to secure that financing for the property. As Cindy said, I'm Faya from 𝗵𝗂 Investments. Brianna Peters from Soul Investors will go over some creative financing strategies. Cindy will do understanding leverage in real estate, and that will roll us right into our guest speaker, who is a self-directed IRA specialist, 𝗬𝗲 𝗏𝗂. I hope I did not butcher your name.
No, you said it perfect. Thank
Oh,
you.
perfect. Thank you. Thank you. Didn't want to mess up the guest speaker's name. So, as always, if we highlight something and we go through it a little too quickly for the sake of time, and you want us to go more in depth on a topic, let us know. We can set up one on ones with you. We can also do full episodes on specific topics so we can get better into the details. Next slide. So, why real estate investing? So, with investment properties, you can enjoy passive income by investing in properties through things like syndication deals, where you kind of put your funds into it, set it and forget it, and allow your money to make money for you without the burden of dealing with like tenants and trash and other responsibilities that the general partners deal with in finalizing the deal and also dealing with the maintenance, the tenants, and all the things that come along with the property. You can create stable cash flow for yourself. Some people want to create an additional stream of income. Some people want to supplement their W-2s. Some people are retired and want things to supplement their retirement funds. So it's a good way to create a stable cash flow. There are tax advantages and deductions during tax time, like, well, yesterday, 2 days ago, that everyone hopefully filed their taxes or an extension. So there are tax advantages and things that you can deduct, right? Reasonable cost of owning, operating, and managing your property. And you can also reap the benefits of depreciation of your property. You can diversify your portfolio. A lot of people nowadays are owners of different stocks and crypto coins and things like that. So it's a way to kind of diversify your entire portfolio. And real estate has a lower volatility than a lot of those other investment options. So it's a good way, especially for long term, to invest your money and see a higher return with lower volatility. And once you own property, you can leverage that to purchase other properties and get money out to do other things as well. So it's a good way to provide leverage for yourself because you're able to use that property as collateral since it is a tangible asset. So while we're discussing our financial portion of real estate investments, mainly because it's the biggest barrier for people. People look at prices of properties, especially larger properties, and feel like there's no way possible that they would be able to afford it. They don't understand how they are actually positioned to leverage some of the things that they currently have, money that they currently have, 401ks, things like that, to be able to get into their first property, their fifth property, just an investment. So it's a big topic, and it's a way for us to try to help people to kind of remove that obstacle for themselves and be able to find a way to finance their projects. Next slide. So there are traditional options, of course, for financing projects, loans and mortgages, which most people are familiar with from just their own residential properties. But then there are also alternative financing options like hard money loans, which are more short-term based loans based on the value of the property, which is used as leveraged as collateral. There are private lenders, private money lenders. They're also short-term loans, and they're used a lot of times to either purchase or refinance property. And so it's a private lender, business or person, instead of a big corporate bank that you're getting these loans from a lot of the time. So the terms are different, the timing is different. It's just smaller than using a larger institution for those funds. There is seller financing, where the person who is selling the property actually maintains the mortgage that they have on that property, and you're paying them, and they are then paying the mortgage. So you guys agree to the terms of that deal. And again, you're paying them, they're paying the mortgage, and that's eventually getting paid off, and you still have the deed and are the owner of the property. There are other things like government-backed loans. Some of more popular ones are like VA loans. There are grants and subsidies that people are able to get. So a lot of alternative financing options. And now Brianna is going to get into some more creative financing strategies.
Okay, you can go to the next slide, Cindy. So creative financing. I touched on a little bit of creative financing, but what is creative financing? So creative financing essentially just allows real estate investors to acquire a property using non-traditional funding methods without basically relying on banks, solely on banks. So these are strategies that are just powerful for investors who may have limited capital, poor credit, or just need to scale quickly. Why do we want to use creative financing? Essentially, it's just to avoid some strict bank underwriting. Maybe we want lower or zero money down. Maybe we want a faster deal execution. We just want to look for some off-market deals. And also to help solve some of the seller problems and be flexible with that. So what are some different creative financing? I'm going to go into it a little bit more on the next slide. Creative financing strategies are seller financing. So this is one method where essentially it's owner financing. The seller acts as the bank. Instead of the buyer getting the loan from the lender, they take over the monthly payment directly from the seller based upon some specific agreed upon terms. So that could mean you're just agreeing on the purchase price, the down payment, interest rates, term, if there's going to be a balloon payment applicable, usually a promissory note, and mortgage or deed trust are created. The buyer gains the equitable title and takes possession, and then the seller receives some monthly cash flow. These are often better rates than banks. Seller financing typically makes sense when the seller owns the property free and clear, so they don't have a mortgage on it, or when the seller doesn't need all of the money right now and they're just looking for maybe some monthly income, a tax deferment, or they want to avoid some capital gains. Or it could just be that the seller is having difficulties selling through a traditional means. Maybe they're emotionally attached to the property. There's just a lot of different ways, and you just kind of want to look for a way to make it a win-win for you as the buyer and then also the seller, or vice versa. The next thing is lease options. So this is kind of more into rent to own. And you basically are the buyer, but don't have the obligations to purchase the property after renting it. So like you're renting it for a set period of time, and then it's a lease agreement with an option to buy at the end of the lease agreement. This could be 1 to 3 years. The buyer could pay a fee. The buyer can rent the property and then apply a portion of those rents towards maybe the down payment. And this just gives a little bit more flexibility. This is ideal for people that maybe don't have the credit right now. They need to work on their credit a little bit. The investors have more control over the property or investors that are wanting to purchase have more control without taking the ownership of the property. And this could also be for sellers struggling to sell and just give them another option. Another creative financing strategy is private lenders. This just essentially is getting money from family, friends, individuals in return for a promissory note or a mortgage, like equity in the property. So investors could just essentially bring a deal to friends, family, business connections, ask for the funds, get it down back. Some other ones, just to quickly go through them, there's a lot of other options. So subject to, essentially, you're just taking over the seller's mortgage payments while the loan stays in their name. This is typically zero down, avoid credit checks. However, for pre-foreclosure or distressed properties, there's something called a wraparound mortgage, where essentially you just create a new mortgage that is going to wrap around the seller's existing mortgage, and the seller receives monthly payments, including a spread. You collect the rent, pay the seller, and then keep the difference. Again, all of these, you want to try to come up with like a win-win situation and get creative with that. Another one is contract for deed or a land contract. You can make payments over time, but you don't receive the full title until the loan is paid off. So this is just a little bit easier than a traditional mortgage, and it's just good for situations that have like title issues or seller distrust. And then another one, which we've talked about in depth on our previous episode, are equity partnerships or JVs. That's just kind of a brief overview of some different creative financing strategies, and Cindy will take it away.
I will take it away to leverage. Sometimes I hit the button again by accident. I'm having some technical difficulties, and my light keeps flashing on and off. So anyway, my portion is to talk about leverage in real estate. Leverage is OPM, leverage, and that stands for other people's money. It refers to using borrowed capital, usually in the form of loans, to increase your potential return on the investment. And it's the idea is to control a large asset with a relatively small amount of your own money by using OPM, other than people's money, to fund the rest. So I do a lot of this for people where they, they call me and they say, I need to borrow some funds to finish a project. And I often help people use OPM. So this is something else that I specialize in besides the three of us raising capital. So, and when you do that, then you can do more properties when you're able to spread the OPM across several different properties. That means that, you still have money in reserves just in case something happens. So that's how leverage can help you grow. And I have that here when I talk about it. It increases your buying power. It boosts your returns on equity when the property appreciates. And again, as I said, it allows you to scale faster by spreading your capital across more deals. A very, very general way of looking at leverage is basically when you just purchase a regular home. We are all leveraging the bank's money, even when we just do our primary residence. If you're buying a house for $500,000, sorry, I got to talk with my hands, I'm part Italian. Your investment that you put in 20% down is $100,000. So then your bank loan is 80% of that. And this is probably could be a rental property or some other property, because in general, most people don't put 20% down like on their first property, but some do. And I'm sure a lot of you are aware, as long as you put 80% down, and you don't have mortgage insurance. So anyway, your property appreciation, your property appreciates 10%, then you have a $50,000 gain. So your ROI on cash invested is 50%, because you have made $50,000 on the amount you invested, which was $100,000. So you've leveraged the bank's money or somebody else's, but usually in general, on larger purchases, you can use the bank's money. So And Brianna talked about these other OPM strategies a little bit, traditional banks, private money lenders, hard money lenders, seller financing, all of these. I think a couple things she didn't totally touch on is syndications use other people's money because that's a group of people who pool their money together to buy a larger multifamily or hotel deal most of the time. You can also use HELOCs. I have HELOCs on all of my properties, and I use those to help me scale. Business credit is another one. You can apply for business credit cards and business credit through your bank. And I also have quite a bit of that I use to help me scale as well. And then lastly, before we get to the really important thing, there's an option to do some crowdfunding, which is a lot like syndication. It's just a little bit different. So we can maybe go into that another time if that interests you guys. But lastly, we're here mostly to talk about self-directed IRAs and 401ks and how you can transform your money into something that you can use towards real estate. So today, Cora has joined us. I met, well, I didn't really meet you there at the conference that I was at, but I met somebody you work with and she referred me to you. And I previously had a 401k through another job that was just sitting there. And I'm like, I got to figure out what I'm going to do with this. So she did give me some ideas and I have started to work on that. I had two and I needed to combine it. So I'm looking forward to getting that into one and being able to use that towards real estate. So I'm going to let Cora take it away. Let's see, we already kind of talked about this. Oh, you know what? Are you going to talk about these things, Cora? How you have different prohibited transactions and different tax referred or tax-free growth?
Yes, I will touch on that.
Okay.
I don't go too far into the woods, but we will touch on all of those points.
Okay, I'll skip over that. And Faya and myself and Brianna, thank you guys for coming. I think everybody I see today, I either know or one of us knows. If I can't find that thing to look at everybody, but I guess what I'm going to have to do is I'll allow Cora to share. So let me
I just sent my request.
technical skills here and see if I can figure that out. So I apologize, guys. I am new to running the controls.
No worries. Do you see my request,
I'm
Cindy?
there. I'm sorry.
Do you see my request?
I don't.
Well, Cindy, I'm going to reclaim as host and then I'm going to switch it over to Cora. Is that okay?
Oh, okay. Yeah, if you know how to do that. Let's see. There we go. All right. And then you're going to switch it over to her?
Already done.
Okay.
Perfect. Getting this now. So while I get this going, I love to get interactive. So I hope you all know how to use the chats. I hope you all know how to use the reactions. I love them. I love to keep it going interactive. I mean, at the end of the day, this is something that I'm really, really passionate about. Can you all see my screen? Give me a clap. I want a clap reaction. Celebrate. Perfect. Okay, so great. Thank you so much for having me today. Like Cindy, I'm also Italian and I speak with my hands, so I have my camera further down so that doesn't get distracting. So who here has heard of using their self-directed IRA to invest in real estate? You can put in the chat reactions. Anyone here have heard of this strategy before? Yeah, it's great. It's a great strategy. I love that. Most of the time when I'm at these events, I'm introducing the concept to it. So it's great that we all have an understanding of that. So quick disclaimer, I will let you know, I am not an attorney. I'm not a CPA. I'm here to talk about us as a passive custodian. I cannot provide any investment advice, legal advice, tax strategies. I encourage you to reach out to those parties who know your unique financial situations the best. So without that, without further ado, I will go ahead and get into my presentation. So, like I mentioned, I'm with 𝗬𝗓 Financial. I'm an IRA specialist. And what I like to do is assist my clients in educating them and assisting them into getting their accounts ready to start to invest in alternative assets like real estate, private lending, in a tax advantage way. So, who here can put in the chat, guess how much money is locked up in IRAs right now? Put any number you think. Let's see. 2 million. Try again. Let's go a little higher. $1 trillion. Okay. Todd, you're almost there. So as of the third quarter in 2024, it's approximately $15 trillion locked up in retirement money. And what's really unfortunate is 17% of that is geared towards investing in alternative assets. So that tells me there's a few things. This isn't a known strategy. The whole concept of being able to use your IRA to invest in real estate or private land has been around since they created these accounts. So I mentioned earlier, I go to a lot of events. I'm introducing this concept, but this is not a new strategy. So I like to say this is the secret of the extremely wealthy people because it's a tax advantage way to do it. And I'm like a missionary to spread the word and assist people in growing their retirement accounts in a tax advantage way. So how do we do that? Cora, what's a self-directed IRA? I get this question a lot, or I'll get when I do send out paperwork, my clients are searching for the self-directed IRA option. Where's my self-directed Roth? Where's the self-directed traditional? We'll get into that, the what's, the hows. But let's talk about it. What is a self-directed IRA? So a self-directed IRA is just a marketing term. It is your IRA. There is no magical self-direction. The way that I like to describe it, and of course you can read what's on the screen here, it's more so about what does your custodian allow you to invest in, or what's on their menu of options. And what we commonly see, which is fine if that's your thing, is stocks, bonds, mutual funds. That's what we commonly see. And you never see on there alternative assets. So when we say self-direction, it's more so about looking at the menu that your custodian has given you, and you self-direct and pick what you would like to choose to invest in. What's great about what I do is my custodian, my company, we're geared more towards the alternative investment side. Of course, we have a brokerage side, but maybe you want to private lend. Maybe you want to look into tax deeds, syndications, things of that nature. Well, those are on our menu of options. And that's what's great about us. So types of IRA accounts that we are custodians for. So of course you have your traditional Roth, SEPs, simples. Do we know the differences between traditional and Roth? Open up the chat here. Yes, great. If you do not, it's fine. That's a common question. One's tax deferred, and one you pay the taxes on the contribution. So Roth, you pay your taxes when you contribute. Traditionally, you pay the taxes later. And of course, the SEPs and simples are for your self-employed or if you have employee plans. All these types of accounts. So of course, every custodian has to abide by the IRS rules and regulations on what constitutes as an IRA account. If you hold a simple or a SEP, those are all things, all custodians have to abide by the same IRS rules and regulations. So alternative assets, these are the lists here. Take a screenshot if you'd like. We do see commonly real estate, private equity. I started with private lending. You don't have to go as grand as real estate. If your IRA doesn't have enough funds, there's different ways that you could start getting into the game, and I'll speak on that further here in the presentation. How are we doing so far? Good, good. So I mentioned earlier tax advantage ways, so tax benefits. So I really like that we were able to touch on earlier, tax strategies on why people are investing in real estate. Something that I'm extremely passionate about is being able to assist people in getting their accounts grown in a tax advantage way, just like the wealthy of the wealth people. So when you hear us mentioning tax-free or tax deferred, what we're really saying is it traditional or is it Roth? You can have an investment that you have started with a small amount. Let's just take example. I love this example. So let's say I have a Roth account and I purchased a house for $100, right? I had $100 in my Roth. I used 100% of it to fund my magical house that I have found for $100. And I found a renter, and this renter pays my IRA the rent every month, and my Roth account is growing. Well, now I want to sell the house. I've had my time with the house. I'm ready to sell it. And I sell it for $500,000 using my Roth. Well, guess what? I'm not taxed on those gains because I already paid the taxes when I did my initial contribution for that Roth. So, great strategy. Of course, we would all like to find that magical house for $100 and get that gain. Anything could be possible. I'm never going to say never. Portfolio diversification. So as I mentioned, most of the time I'm introducing this concept. So one of the things that I like to touch on is when you are changing custodians or maybe you're opening another account, it's not a taxable event. So let's say you are really savvy with the stocks and bonds and all of that, and you want to start dabbling into alternative assets. Well, you could do so. You could take X amount of dollars from your current custodian and just fund enough to get your alternative investment deal going, get your feet wet. But portfolio diversification is a big benefit as well, too. And again, you can have multiple IRA accounts. It's not a taxable event. Financial autonomy, investing in what you know best. I meet a lot of realtors or people who are in the real estate game, but they're investing in stocks and bonds only. Well, invest in what you know best, and I think you have a leg up, considering someone who's not in real estate or stocks and bonds. So it gives you the autonomy to pick and choose how you want to grow your retirement account in a tax advantage ways. Restrictions. So you're like, wow, Cora, this sounds really great. There must be a catch. Well, the catch is small. So the IRS only prohibits two types of investments using your IRAs, and that is life insurance and collectibles. And I think life insurance is the obvious reason why you wouldn't be able to, but I'll say it. Your IRA is supposed to benefit you when you're alive, not when you're gone. So that's out. You're not going to invest in life insurance there. And then collectibles. What might be amazing to me, I could be looking at a, I don't know, 1949 Mustang thinking, that doesn't look cool to me. But someone else beside me could be like, wow, that's so amazing. It's subjective. So collectibles you're unable to use your IRAs for. Another type of restriction would be people restrictions. So individuals who cannot enter into a transaction with the IRA, commonly referred to as a disqualified person. These include, but are not limited to, the IRA owner, their spouse, lineal ascendants and descendants, and their spouse. So one example that I like to give is I cannot invest in a property and then go and reside in that property. You're double dipping. So it looks like we have it. Yeah. Thanks. You could obviously tell, Bob, that I don't know anything about cars. Yes. So people restrictions.
Sorry, I had to do that.
Thank you, Bob. You're like, wow, she knows a lot about IRAs, but not about cars. So I do have a guide on more specific on what would be considered a people restriction, more in depth. But like I said, if you have an investment in mind or you know what you want to do, take those questions to your CPA, real estate attorney, tax attorney, ask them those. Those are going to be the people who could really, really solidify that. We are a passive custodian. Again, I have no legal or tax training or car training to be able to provide that information to you. But I do have a high-level guide that I can always hand out as well if anyone's interested. So how do you do it? Well, I always like to say we are the easiest part of your transaction. It's just opening a bank account, like a bank account for your IRA. So it's just a matter of you can either find what you want to invest in and then open an account, which sometimes they can be time sensitive. So I don't suggest that. I always say stay ready, don't get ready. So it's just a matter of opening up an account, getting some funds in there, or just having a shell of the account. That way, if you find the investment, you're already ready to go and you have your IRA set up. So how do you do so? It would just start, you would find the custodian that you would want to use your IRA that allows you to invest in the alternative assets that you are leaning into. So in this case, let's take real estate as an example. You would fill out a simple application. Like with us, it's very simple. It's who are you, where do you reside, and who are your beneficiaries, and where is the money coming from? Think of it more so as a paper trail in the event that the IRS asks you, hey, where did this money come from? You can cover your butt and you have the proof and the pudding of where your funds came from. It came from this custodian. It's going to this investment. And from there, once you fill out your application, it's just a matter of then you would get your account funded and you would tell us where you would like those funds directed. It's really, really that simple. Finding a custodian. I do encourage people to do their due diligence. Of course, 𝗵spira Financial has been around for a long time. What's great about us is we have everyone who's in our director roles, presidential roles, have been in various different custodial companies that allowed for self-directed into alternative investments. You want a custodian that's going to safeguard your assets, provide your tax documents that you'll need, basically like a receipt to the IRS that you do have a qualifying IRA account and you're using it to invest in alternative assets. Something to keep in mind, not all custodians allow for alternative investments. So if you do have a custodian that you absolutely love and you're looking to entertain this option, give them a call, ask them, hey, could I run the scenario by them? And if not, you know who to call. So I get this question a lot, and it's more so the terminology. You have transfers and rollovers and contributions. So transfers, it's just a matter of the way that your money gets moved. A transfer would be if you already have an existing IRA account. It's already an individual retirement account set up with another custodian, and you just need to set up an additional one or a different one and get the funds transferred. A rollover is a different terminology. These are going to be funds from a qualified retirement account from a 401k, 403b, or a previous employer. We're rolling those funds over into an IRA. And then, of course, your contributions, your annual contributions, of course, depending on what type of account that you have set up, you would meet your annual contributions. From there, you can either fund that ACH or wire transfer into your self-directed IRA account. A little bit about us. So you might have heard of Millennium Trust. Millennium Trust rebranded to 𝗵spira Financial. They're around since in the early 2000s. And more so recently, they have acquired NewView Trust Company and Quest Trust Company, if you're familiar with those names. We have all merged into one, and now we're a heavy hitter in the health, wealth, and benefits sector. I will let you know as well, if you're familiar with 1031 exchanges, we also can assist in 1031 exchanges for clients as well. But we make it nice and simple. So where the complexity arises would be, how do you want your deal structured? Who's in your deal? And what's your end game goal? I do meet some investors who are looking to get a passive income from using their self-directed IRA as well too. I can go over a few scenarios here and show you or let you know how people have had their deal structures. Because if you're using 100% of your IRA funds, remember this is meant for retirement. So, Cora, how do I get some passive income out of this? Well, you can go into joint ventures. And I'll get to that here in just a moment. A little bit more about Inspire Financial, the assets under custody that we have, in how much we've had in individual clients and institutional clients, record keeping accounts. Again, 20 plus years in the self-directed IRA space. This is my contact information. I'd love to go over actually more in depth of some strategies behind using this this tool. So I mentioned earlier that this isn't, if you're using 100% of your IRA funds, you're not going to be able to take those out into retirement without getting hit with a penalty, right? So what do we see? We see people while there are prohibited party restrictions, you can go into a deal with yourself. You can joint venture. So let's say you don't have enough funds, or maybe you are looking for a passive way to get some money with your investments, but also have some tax advantage strategies as well. What we have seen is clients will go into a deal with themselves or with other people. Let's just say 50-50. I go into a deal 50% of my personal funds, 50% of my IRA funds. Of course, anything moving forward as far as repairs, profits, and then of course the taxes, I'll be hit 50% of that profit. So that is a different strategy. I would say reach out to your CPA and let them know, hey, this is what I want to invest in. This is what I'm hoping to gain. How can we make this happen? And a good CPA will be able to advise you on that. I like to say CPAs are like doctors. You have some people who have specialties in self-directed IRAs. Some have specialties in other things. So maybe your CPA isn't as versed in self-directed IRAs. I have resources. You can always reach out to me, and I'm more than happy to assist with that. I see a question here. The actual turnaround time to open and get your account funded, I'd say high end, it could take 2 weeks. But I like to give a little bit more time because larger custodians like to move at the beat of their own drum, and if they're losing money, they're in no rush to send you that check. So I always like to say, if you know you want to use this strategy, and you know your investment deals could go quick, you might want to just set up the account. $1 gets your account funded, just to have it there. That way, at that point, it's just a matter of getting your account funded and moving the money over. What other questions do we have?
Yes.
Yeah. What kind of
Can I use
regarding what
my
kind of
wife's
restrictions?
self-directed IRA to invest in a deal in which I am a general partner but do not have total checkbook control?
Do you get benefits from that deal?
Well, I would on the back end, but I don't have total checkbook control.
I would. Have you ran it by your CPA?
Yes. She says, I think you can. A tax attorney told me he's not sure. It's a tough question. I don't know the answer to it.
It is a tough question. I think it depends. There's a few determining factors as far as, like we have had people who are using their IRAs to invest in their fund, but there's a certain percentage that they can't reach. What I would always say is, so I cannot provide any advice to you or tell you if it's right or wrong. I can tell you a spouse would be considered a prohibited party in most instances, but I don't know how your deal is structured. If your CPA is giving you the green light, I would get that in writing. That'd be my own personal suggestion. Get that in writing. We see that often too. If clients are adamant about that their CPA is giving them the green light, we say, for your own records, in the event of X, Y, or Z, I would have your CPA write something up, or maybe get some other opinions from other CPAs.
Thank you.
Of course, of course.
Or
What else do we got?
You can share your screen again and put your contact information up while you chat a bit. It was super
Of
quick.
course.
People want to make sure they have it.
Yes, I'll get that right now. Are we all about in the same area of the country? Are we all spread out?
Very spread out.
Yeah, a little bit. We've got 1, 2, 3, 4 of us who are in Colorado.
Yeah, that's me.
Yeah, that's you, Bob, and me, and
Still looking for that 1948 Mustang. When you find it, I want to buy it.
oh, you stop it. I know where you live, mister.
Ohio, Texas. I'm in Florida. I'm in Florida, so I'm on East Coast.
I'm in Florida too. Where are you at in Florida, Cora?
I'm in Orlando. How about you?
Fort Lauderdale.
Oh, okay.
Not too far.
Yeah, not too far. Yeah, I'm in Florida, so it's starting to get nice and warm and humid here.
Mm-hmm. I was going to ask you, what are the tax advantages of using this quote unquote self-directed IRA and running the alternative investments like real estate through your IRA?
I always like to tell people it depends on your strategy. You're eliminating capital gains. You know, there are other tax advantage strategies. You know, I work with a lot of investors. Are we predominantly investors and real estate in this group?
I believe so.
Yeah. So I do commonly see a lot of people doing 1031 exchanges as well too. If we do that, which Inspira as well, I can connect you with our 1031 side. But it's just a different strategy. 1031s, I like to say you're delaying it, because you are. But you know, what's your strategy? And I don't think there's a right or wrong way. I just think it really depends on what is your specific end game goal and what are you looking to get now. Some people, they just want to grow their retirement account really fast in something that they're familiar with. Some people, they just want to try to reduce their or grow it in a tax advantage way, I should say.
And you talk about, I'm looking it up a little bit here about the UBTI. Do you know about the unrelated business taxable income? And can you talk about that a little bit?
Yes. So UBIT, we like to call it UBIT for short. It's basically sorry, has everyone gotten my my information?
Jillian needed it. I can always, if she didn't get it yet, I can definitely get it to her. I'm sure she did.
Yep.
Great. And if we need it again, no worries there. Yeah. So UBIT, I guess it depends as far as would you experience it using your self-directed IRA. It really depends on what you're using your self-directed IRA for. Some of the things I like to give a scenario here, or I guess an analogy of how UBIT is if you've never heard of it before. So let's say you have a lemonade stand and you decide to use some of your allowance money to buy a lemonade stand kit. Now, let's say your lemonade stand is part of a special club where you don't have to pay taxes on the money you make selling lemonade because it's a special club that allows you to save money. But if you decide to use your lemonade stand to sell lemonade for someone else, like if you let someone borrow your stand and they pay you a little money, you might have to pay a special tax called UBIT. So it's basically saying like, hey, if your lemonade stand is making money in a way that's not part of the club's rules, you have to pay a little bit to the government for it, if that helps with the analogy. That's the best analogy that I think translates into the average Joe understanding. Not getting too deep into like tax law and things of that nature, tax codes and things of that nature.
Thank you. Does anybody else have a question?
I
Possibly
have
even.
one.
Oh, go ahead, JR.
Yeah, is there a difference amongst like companies such as, I guess I would imagine a competitor of yours? Um, are they like commission based? Because I have one that been calling me constantly to try to get me to roll over my IRA or Roth to her, and I kind of heard it through private or a lender, and I think that's how we connected. So I was just curious is there any difference from other companies?
There are. There are. It depends on their structure. And a disclaimer, I always say, ask for their fee schedule, do your due diligence on what makes more sense for you and what you're wanting to invest in. But there are other custodians that charge percentage-based fees, or their team gets commission based off of it. Um, I'd say just do your due diligence. You know, if you have an investment and their annual or quarterly fees make sense to you, and it works great for your scenario, that's amazing too. With us, we're very straightforward and transparent. They're flat rate fees. They're not based off a percentage. Our annual account fee is $100. You don't start seeing additional fees until you have investments, and as you grow, it's still flat rate fee.
Gotcha. Okay. Good to know.
Yeah, yeah. Are you looking to utilize your IRA to start investing or private lending?
Possibly. I mean, it's getting pretty decent return, so I really haven't thought about it, you know. I don't have
Yeah.
to, I just kind of set it there and kind of visit here quarterly or annually with my financial guy, and I mean, it seems to be doing good. So, but I mean,
Yeah,
this is something
good.
new that, like I said, I just kind of stumbled upon, and kind of been tossing that idea around whether or not should I play with it and see what kind of returns I can do with real estate,
Yeah, yeah. It's a really great, I'm an advocate for diversifying your portfolio. What's working for you now is great. I never try to steer people into just going all in at once. I do think it's diversifying your portfolio is something that you really could do. I do find with the financial advisors, I commonly see them geared more towards stocks, bonds, and mutual funds. I don't see a lot of investing in alternative assets, but that's just in my area.
know.
But yeah, I always think if there's one takeaway that we could get from all of this, since we all have a base knowledge of investing in with your IRA, it's more so about having all of the knowledge to really make sound decisions or entertain other possibilities as well to, at the end of the day, grow your retirement account and benefit.
Absolutely. Thank you.
Of course, of course. Thank you so much. Anyone else?
I don't think so. I think you
Thank
did.
you, everyone.
Unfortunately, my stuff is all tied up within my employer's account. So there's nothing that I can really do with that, I don't believe, unless you have some advice on that.
Yeah, I hear of that a lot commonly. And my suggestion to you would be to ask the plan administrator what your options are, not your HR. And the reason I say not HR is just because, I mean, maybe you could ask HR too, but what I do find is they don't know the ins and outs of the plan. What I commonly see is employers allow it, but for example, what you might find is their contributions, if they're assisting as well into the 401k, will stay with, let's just say it's Fidelity. They will stay with Fidelity, and your contributions will go to another custodian that you want. So I do commonly see that. I think if you are in that scenario, to anyone else who might be listening, reach out to your HR, but more importantly, reach out to your plan administrator. So if it is Fidelity, ask them, hey, how much is my employer contributing? What are the guidelines behind that? Can I, even your CPA, hey, can I open up another account, or what does this look like? Strategize. Who's on your team? Who is on your team is really what I would advocate.
It is Fidelity, and I have spoken to them about it. And basically, they kind of told me that until I leave the company, that it's pretty much frozen. There's not really much I can do with it other than basically on the stock market is the only thing I can do. And it's basically just give them ideas on where I think it might be beneficial. And 9 times out of 10, they won't listen to me anyhow. And that was actually is what they said to me.
Yeah. Have you reached out to your HR?
No, I don't. I haven't spoken to HR about it.
Maybe try them because I will say another thing to keep in mind, you know, no custodian wants to lose your business or think that they're losing your business. So I'll just throw that out there as well too. So they might do what they can or say what they can.
I'm assuming
Exhaust
is that a
all
401k?
options.
Is that for a 401k option? Is that what that is?
That's what it sounds like. It sounds like we still have a current 401k that an employer is contributing to.
Could he start a separate one?
Potentially, yeah.
What would employer? Because you kind of mentioned that, and I thought that was interesting. That you said, I was taking notes. Where did I write that down?
Yeah, you can have multiple IRA accounts. So that's why another thing, you know, I would say exhaust all of your options. HR, CPA, the plan administrator. See what options you have, because if you can have multiple IRAs, what would be stopping you at that point? At that point, is it just the contributions? Is it the plan? Like, there's so many ways to investigate it before ultimately saying, like, I don't think this is an option. You know, I would go into it with a way, how can I make this work? Would be my headspace.
And if there's like an investment plan in place, if it's a 401k, sometimes you can take a loan out of it. So you can take money from it, depending on what that fee structure looks like, and put it where you need it so it grows faster than it would sitting there, and kind of put that back and use the rest of the money to invest in other things.
There's so much strategies that you could do. Like I said, I started with an air conditioner unit and used the guy's truck as collateral. And you can get so creative.
Oh, we lost.
Oh man, he lost his.
All right. Does anybody else have anything? Well, Cora, we are so thankful you came. I would love to possibly have you on in a couple of months again.
Yeah, thank you so much for having me.
This is kind of a small crowd tonight, I would have to say. So I think it's that time of year too, spring, and you know, I know we got graduations and things coming up. So maybe in a few more months we can have you on again. And
of course, happy to talk about this.
Yeah, information. And I guess if nobody else has any other questions, 𝗫𝗫, did you have anything you wanted to add, or Brianna?
No, just thank everyone for joining. We will send out a link for the recording. We'll make sure everyone has your information, Cora, as well as our information if you guys need one-on-ones or have topics of things you want us to discuss and see like full episodes on. So thanks again. Enjoy the rest of your evening.
Thank you, everyone. Have a great evening.
Thank you.
Bye.
Thank you.
Bye.